Hi everyone, and welcome to this IDC session on financial services in the next normal. Today we want to talk about how financial institutions are shifting gears from perseverance to acceleration in the light of what's going on with the pandemic. My name is Zink, and I'm a research director for IDC Financial Insights, and I'm leading the European financial service research. I wanted to begin today by talking about a framework that IDC has developed over the last couple of months, which we call the recovery curve. And it maps out how institutions are looking at different priorities as we move through the pandemic crisis. Obviously, in the early onslaught of the pandemic in March, April, focus was plainly focusing on business continuity and keeping the lights on. Whereas in the next phase, the focus was really shifting towards value-generating initiatives, really generating as much return on investment on your investments as possible, and to close some of the gaps that are still apparent in the digital channel proposition. After that, and that's the phase that we're entering now, we really see organizations shifting their view and focusing strongly on operational resiliency. And some of the leaders are already moving to the next level where they are really planning and thinking about how they can future-proof their business for further shocks like the pandemics or other external shocks that might hit their business, and really modernize their infrastructure to set up their business and future-proof their business for what is coming after the crisis and in the continuing recovery. Obviously, there are a lot of different priorities that banks have been driving throughout the crisis. What we clearly see is that, particularly in the early onslaught, the focus was very dominantly on creating digital trust, so focusing on things like security in the picture of the growing cyber attacks that we saw across the world, as well as focusing on fraud, as we suddenly were in a new environment where we had to send thousands of people, of staff home to really ensure that there is no room for fraud. The other key priority that we've seen is obviously banks and insurers investing strongly in building better digital customer experiences. But then there are also a couple of other areas such as digital lending that really showed that we had some weaknesses, and particularly of the light of this new digital ecosystem, in the light of the digital customer interaction that we are driving. And it very quickly showed that the way a lot of organizations go about lending is still very much anchored in the past. And obviously, as we move along, I already mentioned that organizations are now focusing more on efficiency and agility, building and modernizing a modern platform to run their business on, modernizing infrastructure, particularly moving into the cloud and to leverage some of the added attributes that cloud brings to us, such as scalability, flexibility, and speed. Today, I want to focus primarily on the experience, customer engagement, and on digital lending. So let's jump right into what banks have been doing over the last couple of months and some even years. And what we see today is that personalized experiences are something that financial institutions are trying to bring to the market. And we see particularly a lot of activity around giving more actionable financial recommendations to help clients better plan for their financial finances, becoming more actionable also in terms of reminders. So you have a bill to pay, you have to respond here to really help customers also avoid unnecessary fees and penalties. And then there's obviously a strong focus on also driving security by involving the customer in a different way. So a lot more alerts are sent out for suspicious transactions that prompt the customer to confirm that this is really a wanted transaction. We also see the rise of more gamification elements such as spending goals, rewards, discounts, and so on, to really take digital customer engagement to a new level. And lastly, some organizations are also trying to bring sales down to a more personalized level to really identify the right moment when a client actually really needs a financial product the strongest. But the question is really, are all those cosmetic changes that we are seeing today in the customer experience what is needed to really deliver striking and really good customer experiences? And one thing that we found in our research is when we did a consumer survey that European consumers really have very diverse needs. Yet most of the financial institutions go for a one-size-fits-all approach when it comes to digital channels. And this is not really helping them to address the specific needs of those unique consumer banking archetypes. That's how we coined it. And as you can see, this is a European sample. We have identified 5 distinct archetypes that really differentiate different groups or different segments of customers and their expectations and preferences for banking. So you have the urbanites that really strive for very unique banking experience. They look for fancy tools. They want to be on top of what technology can deliver. You have rationalists that basically seek for the best deal at the lowest price. You have loyalists that basically do banking as always. They do more research online, but they still value that human interaction. They want to come to a branch to have a discussion with a human, and that is a very large group, or still the largest group that we've found in our sample. And then you have other segments such as traditionalists that really don't like financial services. So they only interact with the bank when it's really necessary, and they want to be in control of how the bank interacts with them, and they want to have the choice of channel as well. And then lastly, we have the strivers, which are the young people, the millennials, that have a very different view of life. Those are the guys that we saw going out on Fridays to demonstrate against climate change. And they really live and breathe online, but they have very limited trust in banking, given that basically throughout their life, banks, the most they saw of their banks is when they are hit by scandals or when they're causing financial crisis. So really a very different customer segment to engage in, a very challenging one at that. Here, I quickly outlined some of the expectations that those segments had. And as you can see, these are very different when it comes to digital channels. So some segments, obviously, very high demand for digital channels, where others are extremely low. The strengths of the relationships also differing a lot across these segments, as well as their willingness to pay for value-added services. I think another critical element here is the willingness to share data. And as we are moving more towards data-driven financial services, getting customers on board to share data in exchange for value will be a critical thing that banks need to get better at. I also wanted to talk about the ecosystem, which is clearly or has been a big priority for financial services organizations before the crisis. And to some degree, the ecosystem will also be able to support financial institutions in delivering this more segment-based channel propositions. Because, for instance, it's through PSD2, the customer will have the choice of the mobile application they want to use for doing mobile banking, for instance. They don't have to use the banks any longer if they don't like it. But obviously, there's a big risk that this might also disintermediate customers from their financial institutions. So banks should not really, this cannot be an outcome that banks want to. So our big recommendation here is really that they should go out and innovate and build better channel propositions themselves. And they should also be looking at the ecosystem much more as an opportunity for them to innovate business models and to open up new revenue streams. And this is what this slide is essentially talking about. IDC has built this data model where we've kind of looked at and identified 60 open banking use cases where we think banks have a business case, and we modeled those use cases from ground up to really come up with an idea of how big is the opportunity in ecosystem banking for end users for financial institutions from a revenue perspective. And as you can see, there is a lot of change happening. It's growing into a sizable business. For EMEA, we see that the CAGR is already up around 8% over the next 5 years. And this will mean that by 2024, something between 5 to 10% of total bank revenues will be generated through those new ecosystem business models. And that is quite a sizable amount. And banks who miss out on building this will obviously face some challenges as we further proceed into the digital era. What could those digital banking models look like? And we have also split down those use cases I was talking about into different clusters. And I think the biggest opportunity that we see is around data monetization. We have seen a couple of banks, such as BBVA, for instance, trying to build out APIs where they sell socioeconomic data or payment statistic. At the moment, not for monetary gains. I think they still want to get users of data accustomed to use the data, but obviously the goal behind it is to monetize that data. And I think a couple of other organizations, such as Deutsche Bank, is also building out massive API libraries really to build new value-added services that they can provide to the market. The next biggest is around proprietary platform services. So the bank allowing third parties to use their platform to distribute their products or to distribute services to supplement their own offering. A really interesting opportunity is what we coined anything as a service or X as a service. And this is really the bank rethinking their operating model. And instead of providing products primarily to the market, they become a service provider to the market. And a good example for that, that's already quite popular in some markets, is banking as a service. So a bank with a license is going out and provides the infrastructure, the operations, and the bank license to a third party, which could be a telco, could be a retailer, to allow those customers to run financial services with their customer base. Obviously, banking as a service is a very high level, but you can really drill that down to quite a specific solution horizon as well. So treasury as a service is a great example. The bank, the corporate bank, goes out to the customer and manages their treasury operations on behalf of the customer, taking on the day-to-day activities and really helping customers that way optimize and streamline costs in running this business by themselves. Other opportunities around data partnerships, external marketplaces, and then to a lesser degree also transaction and account services. So in essence, what we are really predicting here is that the ecosystem of providing financial services will become a lot more diverse, and a financial institution cannot in isolation really deliver these great customer experiences without the support of the ecosystem. Plus, they may lose out on a big opportunity to diversify their business model for the digital era. And last, I wanted to touch on the importance of getting smarter about credit decisions. Clearly, COVID-19 has shown impressively how quickly circumstances can change and how quickly traditional lending models might quickly run out of relevance when it comes to an external shock like we have seen over the last couple of months. And that means we need to become smarter about and more open about the data and the factors that go into our lending models to really move towards smarter decision. And that increasingly means bringing in external data, enrich our own data with more information to end up at smarter models, and also to cast a wider net of different data points that we factor into our lending models. To me, this transformation ultimately boils down to 4 key components. The first one is more a technology one. It's about bringing in the power of predictive. So investing in new technologies to build more advanced credit models and enable quicker credit decisions, and use new technologies such as machine learning and artificial intelligence to optimize and refine those models and generally become smarter about it. Second, it's about model rebuild and management. So that means instead, I think a lot of the traditional models that we are having, they still remain valid, but we need to enrich them and we need to get smarter about how we use different models to come to smarter decisions. So that means improved model governance, smarter, more optimized selection, optimization of credit models, and also increasingly bringing external models that have been proven to work well. Just think of how, for instance, in India, organizations are looking at mobile prepaid top-up data to make decisions on customers that do not have a traditional banking relationship. And I think this is the kind of thinking that we need to bring in to really modernize this area. Third, and I think that's probably the most essential one, is the use of new and open data. So look for new, more diverse data sources that also come from the external world, whether that's from the customer himself or from the ecosystem, whether that's ERP data or cash flow forecasting or client behaviors, or also looking at who are my customers' customers to really build more reliable data and to make smarter predictions about how external shocks will affect the business of my customer. That goes hand in hand really with not just using that external data, but also enriching your internal data and models with that external open data. And lastly, it's about getting smarter about how you price risk. And I think we have been talking about risk-based pricing for a long, long time. Yet still, relationship managers have a very firm hold over pricing in terms of credit. And I think this is something that organizations need to become more disciplined about, to really have an algorithm, have a data-driven pricing mechanism instead of a human emotional type of pricing strategy. And I think with that, we really see how already today, or we predict how organizations will be using a wider array of data to make smarter decisions. But it is a difficult transformation because we obviously see some headwind from regulators here. They are increasingly, or their utmost priority is obviously to ensure ample credit in the market, but they also insist on explainability of credit decisions. And I think in the past, this has often been handled as mutually exclusive with automation of credit decisions, which it doesn't have to be. I mean, just because a machine is making a call doesn't mean that cannot be explained to the customer. So I think this is an area where we obviously need to work with the regulators to really convince them and make decisions explainable to customers when they don't get a credit approval of credit. With that, I want to end my presentation for today and in quick summary, take you through the most important messages of today's presentation. So first, European FSI are still bracing for the fallout from COVID-19, but we see how they are gradually shifting from business resiliency towards acceleration and preparing for the future that's coming after the pandemic. How do they future-proof their infrastructure, and how do they move back from those tactical investments that we've seen over the last couple of months more towards the strategic transformation drive that really builds the right foundation for what is needed in the future. Second, it's really time to rethink how we go about digital and seriously take digital all the way by rethinking also the channel experience and not just do cosmetic touch-up to certain channels, but it's really about delivering a good experience to all customers. And that has to be built on their specific requirements. We believe that the ecosystem and data will play an important role to enable this transformation, but ultimately it is really about the financial institution as well to make the right decisions on delivering a better customer experience and delivering the right support and engagement strategies to address specific customer segments and move away from this one size